What does this look? Ooh. It's the look your accountant makes when everything balances on your balance sheet. For those of you who know what I'm on about, nice. For the rest of you, we need to get you up to speed. Today we're talking balance sheets, and it's about time you gave them at least 5 minutes of your time. Yes, your accountant is there to take care of such things, but I'm sure she'd prefer not to constantly hold your hand over the basics. So this is Balance Sheets Explained in 5 minutes. I'm Aidan, KENEALY. We've got lots to cover, so let's put 5 minutes on the clock. There it is, and let's get into it.
Oh, what are you saying?
First up, the TLDR. In short, the balance sheet helps us to understand what the company owes and owns. It does this by listing out the company's assets, liabilities, and shareholders' equity for a specific point in time, all in one place. That's useful. We then use this information in conjunction with our other financial statements, the income statement and the statement of cash flow, to work out if the company is performing as it should be. As founders, we need to know our way around the balance sheet so we can talk to our accountants, board, and shareholders with some semblance of credibility about the company's liquidity, asset performance, and capitalization structures. And so that's the TLDR. Now onto the more but brief detail. Well, let's talk balance sheet equations. There's a very simple equation that defines the balance sheet for us. This is assets equals liabilities plus owner's equity. It's an intuitive formula that describes the realities of a company. The things that the company owns, i.e. their assets, must be funded by either taking on debt, liabilities, taking on investors, shareholders' equity, or investing any profits earned back into the business, retained earnings. Put another way, the value of your business assets must balance the sum of what you have borrowed, raised, or retained in the business to acquire them. And that wraps up the balance sheet formula. Pretty easy, right? Now it's on to what's on the balance sheet. First up are our assets. A company's assets are things both tangible and intangible that have a realizable future value. This includes, but isn't limited to, things such as cash, equipment, prepayments, accounts receivable, IP, and goodwill. On the balance sheet, the assets are listed in order of liquidity, or how quickly they can be converted into cash. And to help us with this ordering, assets are categorized first as either current or non-current, where current assets are defined as those that can be converted into cash within a year, and non-current assets are those that can't. Next are our liabilities. A company's liabilities are what the company owes to outside parties. They are also categorized on the balance sheet as current and non-current and listed in the order of when they are due. Examples of current liabilities include, but aren't limited to, things such as accounts payable and interest payments, and examples of non-current liabilities include things such as long-term loans. Finally, there's shareholders' equity. A company's shareholders' equity is the value attributed to what the shareholders, owners of the company, own. In other words, it's what's left over when the company's total liabilities are subtracted from their total assets. On the balance sheet, shareholders' equity is categorized as either stock, which is the ownership vehicle for investors, and retained earnings, which is the profit retained in the business from previous financial periods. If it's not distributed in the form of dividends to shareholders, retained earnings are either retained by the company to reinvest into new assets or pay down debt. And in most startups, any profits are usually retained to fuel growth, and are very rarely distributed to shareholders. And with that, we've summarized what's on the balance sheet. Now it's on to what the balance sheet is used for. The balance sheet provides the information necessary to evaluate three broad aspects of a company. This is 1, working capital and short-term liquidity, where we compare current assets and liabilities to assess the company's ability to cover its short-term obligations. Number 2 is asset performance, where we look to see how well the assets are being utilized by the company to generate a return. And number 3 is capitalization structures, where we look at debt to equity ratios, which give an insight into how the company is funding its operations. What these measurements should be and what values they should have are all context dependent to the company in question, and what the company is trying to achieve. In general, however, ratios and metrics relevant to each of these three categories are what most boards and shareholders analyze to assess a company's performance. And with that, we've summarized what the balance sheet is used for. Now it's on to the balance sheet's limitations. The main limitation of the balance sheet is that it only provides a snapshot of the financial position of the business for a single point in time. It doesn't provide any information on the changes in assets, liabilities, or equity between balance sheet periods. This is why the balance sheet shouldn't be viewed in isolation. We need both the income statement and the statement of cash flow to get around the limitations of the balance sheet to provide the insights necessary for a complete picture of the company's performance. And with that, we're all done. Balance sheet summarized in under 5 minutes. If you're still here, thanks for watching. I trust you enjoyed the video. If you like this format and found this video of use, then hit the like button and tag any other founders that may also find it of use. And make sure you follow me on LinkedIn if you aren't already, to ensure you can see more of the content that I produce just like this. Until next time, my name is Aidan KENEALY, professional founder coach and advisor to high growth startups, helping you, the startup founder, to be better than yesterday every day.